Good afternoon, everyone. This is Financial Literacy 101. I'm your host, Ross World, and today we'll be talking about a couple of topics. We'll be talking about tax deductions of your 2019 tax return. That's what you guys are actually filing, right? You're filing your 2019 tax return in the year 2020. So that's what the title is there for, as well as we're talking about some mortgage, right? When you refinance your mortgage. So because of the amount of information, let's get right into the information that is at hand. Now, anytime I tell you TCJA, that means that it's the Tax Cuts and Jobs Act, okay? The Tax Cuts and Jobs Act. And now we understand that President Trump, he implemented that when he came into office, and it kicked in 2018, and it has certain escalations throughout his 4-year term about what they're going to do. Now, there are certain things that went up, certain things that went down, but we have to understand that tax credits are subtracted from the taxes you owe, okay? Tax credits are subtracted from the credits that you own. Now, all three of these elements have been impacted by the TCJA. The TCJA, again, TCJA means Tax Cuts and Jobs Act. So when you hear me say TCJA, I am talking about the Tax Cut and Jobs Act. Now we understand that tax credits are subtracted from the taxes you owe, and all of these elements have been impacted by the TCJA. Now, a lot of these have affected you in many different ways. For example, if your AGI, okay, adjusted gross income, okay, AGI is adjusted gross income, is $100,000, right? You owe $18,200 something in taxes. So a $10,000 deduction or exemption will reduce your AGI to $90,000. Okay, so your adjusted gross income is $100,000. You owe $18,200 some odd dollars in taxes. So a $10,000 deduction, right, or exemptions will reduce your AGI to $90,000, resulting in a tax bill of $15,800 some odd dollars. Now, with a credit tax of $10,000, your AGI will remain at $100,000, but your taxes will be at $8,000, roughly. The amount you get, the amount you get by subtracting $10,000 from $18,000. Okay, $10,000 from $18,000. That is where that amount is coming from. All right, I know that was somewhat confusing. I apologize, but that's the way how they write the tax code. That's the way they write the tax information in order for you to be simply confused, okay? And that's why the American government is the richest government in the entire world, because of taxes that you pay, right, to live in this great country of ours. All right, moving along. Now, they also have higher standard and deductions for these particular things, right? So the TCJA raised the standard deduction from $6,300 in 2017 up until 2019 to $12,200 for individuals and $24,000 for couples and married couples, right, filing jointly. The standard deduction for those filing as head of household will rise to the standard deduction for those who are filing head of household was $9,500, but now it is raised into $18.3 thousand. So $18,300, okay? Now, the federal income tax in some states have higher deductions depending on where you live, and also your particular age. So you have to really do a deep dive into these new tax codes, tax cuts, tax deductions, tax credits, because this is solely going to give you an estimation, a guesstimation of how much you'll be paying in taxes for one, and two, how much you'll be getting back on your tax return. Another key point to take away is there was a lot of benefits for businesses that was taken away that is going to have them to pay more taxes. Okay, here's one. The commuter tax benefit. They said in the past, your employer could reimburse you up to $20 a month for $240 annual a year for bicycle commuting, an expense tax free. In addition, your employer could take a deduction for offering the benefit. Now, the TCJA suspended that benefit for both bike commuters and their employers. It has also removed employer deductions for parking, transit, and carpooling. So that is something to really look at, okay? All right, moving expense deduction. Moving expense, right? Says costs associated with relocating for a new job to be deducted on your Form 1040 as an above-the-line deduction, which you could subtract from your gross income. The distance you are moving doesn't matter anymore. Moving expenses are simply not deductible, with one exception: if you're active duty military and moving from a service-related reason. But now, moving expense deductions are eliminated. There's no more moving expense deductions, okay? Alimony deduction. Alimony deduction. In the past, the person making alimony payments received an above-the-line deduction, and the person receiving the alimony counted the money as taxable income. Effective in 2019. This is our tax season for 2019. We're living in 2020, remember, but we're still filing from 2019. Effective in 2019 for any divorce that happens after December 31st, 2018, the paying spouse will no longer receive a deduction, and the receiving spouse will no longer have to declare their payments as taxable income. Why? I mean, I'm sorry, I'm off script, but just going over here, my notes and reading this information, the big question I have is why? I'm going to read that again. For you people out there paying child support or you're paying alimony, I'm going to read this again because I think, listen to this. In the past, the person making alimony payments received an above-the-line deduction. So when you pay alimony to your former spouse, you could account that on your taxes as a deduction, which lower you in the tax bracket so you don't pay the same amount of taxes if you would if you didn't give the money. Okay, I'll make it plain and simple. I'm going to use big numbers because we can understand big numbers just like that. I'm making $50,000 a year. I give my former spouse an alimony payment, of $10,000 every year. In previous tax years, when I did my taxes, now I am at $40,000. So I would be taxed in the tax bracket for $40,000, right? Maybe 15, 20%. Now they're saying they won't count me paying alimony as a tax deduction. So even though I'm paying alimony, I would still be paying in a tax bracket of $50,000. I'm going to read exactly what they have, but hopefully I painted the picture on this one. In the past, the person making alimony payments received an above-the-line deduction. And the person receiving the alimony counted the money. The person receiving the alimony, counted the money as taxable income. So whoever you was paying money to, they had to file that on their taxes for the government to take money from that. To be taxed on that new income coming in. All right. Effective in 2019 for any divorce that happened after 12/31/2018, the paying spouse, you're paying whoever, will no longer receive a deduction on their taxes. So you're going to be in the same tax bracket whether you give her the money or not. Now, and the receiving spouse will no longer have to declare payments as taxable income. So what they did was they flip-flopped it. They flip-flopped this one, right? And I'm going to read the child support one, but this is alimony. It said, okay, well, if you're paying alimony, we understand that you don't have that amount of money anymore because you're paying it to your significant other. You're paying it to your ex-spouse, your ex-husband, your ex-wife. So you don't have to pay as much in taxes because now we're going to deduct that from your yearly salary amount, the amount you're making in a year. But because your ex-spouse is receiving income, we're going to tax that amount because that's new income. That's income. Okay. I got that. All right. They say, you know what? No. Now we know what this is at, okay? And I'm not against the Me Too movement. I'm not against women, any of that. I love everybody. But either make it better, don't make it worse. Because now they're saying the person who's paying the alimony, which are probably mostly men, right? Statistically, more men pay alimony to their wives, their ex-wives, than ex-wives pay to their ex-husbands. Let's just keep it real. So now, let's take for instance me, I'm gonna pay money to my ex-wife in alimony, so I stay in the same tax bracket, but that's still money out my pocket that is not paying taxes. I'm not going anywhere. I'll say, okay. Then it goes to her as income, but she's not being taxed. So she is no longer being taxed. I mean, how about this, American government? What about if we just don't pay taxes? Like, I'm gonna pay alimony, she gets the income, and that's cool. But they balanced it, they flip-flopped it. I don't get it. All right. Child support. It says payments initiated before 2019 are not affected. Child support payments are different. They are non-deductible by the paying spouse and tax-free to the recipient. I'm gonna read it again. They are non-deductible by the paying spouse and tax-free to the recipient. Again, unfortunately, this is mostly men, but I know there's women out there that's paying alimony and child support, but this is mostly men. So if you're paying child support, men and some women, that is no longer, for this tax return 2019, is deductible. You have to be in the same tax bracket paying even more taxes, essentially. Because at first, if you was claiming that you was paying child support, you was actually paying less. And then the recipient is tax-free. I'm not mad at the other side of it. I'm not upset about, alimony payments. That's not going to be counted as income. Child support, that won't be taxed. So why are you going to tax the money that's going to the child? But the other part of that, if I'm making $50,000, I'm paying $10,000 in child support and alimony. Why are you not going to allow me to use it as a deduction? Because that deduction may lower me in a lower tax bracket because that money is going to my ex-significant other or my child. I don't get it. Anyway, moving right along. Gift and IRA instead said once adjusted, tactic for paying spouse involves giving the receiving a spouse a lump sum in the IRA. Okay, I wrote that down for a reason, but we'll get on that. We'll get on that a little later, maybe in another video. Here we go. Medical expense deduction. This may tickle your fancy. Okay, medical expense deduction. The deduction for medical expense is not going away, and for 2018, you can deduct unreimbursed medical expenses that exceed 7.5 of your AGI. Of course, AGI means adjusted gross income. And they're talking about on Schedule A, just like last year. However, this deduction will be subject to 10% of AGI threshold for the tax year of 2019. Okay. SALT tax. Here we go. SALT tax. The Schedule A deduction for state and local tax. So SALT is state and local tax. The Schedule A deduction for state and local tax used to be unlimited. These include income taxes or general sales tax or real estate and personal property tax. With the passage of the TCJA, that's the Tax Cuts and Jobs Act, the SALT deduction is now limited to $10,000, $5,000 if married filing separately. This can be a real problem for people in states with high income or property taxes such as Florida, New York, and California. Now, with this particular SALT tax deduction, there are some states that are fighting back, okay? Connecticut, New York, what other states are? I think those are only two right now that are fighting back. So let's move on to another tax. Foreign property tax. Foreign property tax. Now, if you got property overseas, listen up. The TCJA eliminates the deduction for foreign tax paid on real estate. Think about it. The TCJA eliminates the deduction for foreign taxes paid on real estate. That means when you were saying, I have property overseas, and you was paying money, it says that the deduction for foreign taxes paid on real estate, they are eliminated. So you have no more deductions because you have property overseas. No more deductions. Previously, you could deduct foreign property taxes on Schedule A just as you can in the United States, either for your regular residence or a second home. Because a lot of us have second homes. Well, a lot of you have a second home. I barely got this one. All right, here's some more interesting stuff, guys. Mortgage interest deduction. Mortgage interest deduction. In the past, you could deduct interest on a mortgage up to $1 million. I say it again. In the past, you could deduct interest on a mortgage up to $1 million. Beginning this year, the limit is $750,000. $375,000 if married, filing separately. Now, Zillow anticipate that just 14% of homeowners will claim the mortgage deduction in 2018. Previously, 44% claimed it. So you see how this mortgage interest deduction has changed to the point where it was 44%. Now it's going to drop. They predict only 14% are going to claim it because of the change in the deduction. If your loan originate on and before December 15, 2017, you may still deduct interest on the old $1 million amount. $500 for married taxpayers filing separately. Okay. Now, if some of you are weary as far as, I'm saying a lot of terms, I'm going to break down what a tax deduction is. That may help because I love tax deductions because I always give the charity. That is a tax deduction. Hopefully they don't give away with that. Now, this definition is coming from Investopedia. It's dated June 29, 2019. A tax deduction is a deduction that lowers a person's tax liability by lowering its taxable income, right? So it's kind of like when I donate, it says, so if I made $80,000 a year and I donated $5,000 of clothes, that was and I get one of those, I got one of them. I always get one from Goodyear every year. And when I file my taxes, right, I file that with my 1040, either easy, standard, or you do itemized. That's going to lower me in my income amount, right? So I donated $5,000 worth of stuff, clothes, shoes, furniture, whatever it may be. So now when I have that and the IRS goes over and say, okay, well, he did his $5,000 of charity, so that's a tax deductible. And in these brackets, now let me also break down tax brackets, okay? I don't know this by heart, guys, so I'm looking it up as we're talking here. But it's imperative that you know this because every year I donate $5,000 worth of stuff to Goodwill, and they put it on the list, and they have a tax ID number so the IRS can read that, and then they sign off on it. All right. So we about to go over these tax brackets, okay? I'm going to finish reading this definition. I'm going to read it one more time so you guys understand what a tax deduction is, because this is very, very important. Because I know some of you got your W-2s and you about to go down and file a tax and you got all these plans for your money. But wait, hold fast. Now, granted, if you know somebody that work at Goodwill, you have to have them dated prior to December 31st of 2019. Prior to, because if you go out and do it now, it's going to count for the next year, not this tax return season. I read it again. A tax deduction is a deduction that lowers a person's tax liability by lowering his taxable income. As I was saying, I donated $5,000 worth of stuff. I made $80,000 a year, but when they look at me in the tax bracket, only $75,000 worth of stuff. Deductions are typically expenses that the taxpayer incurs during the year that can be applied against or subtracted from his gross income in order to figure out how much tax is owed. Now, we're going to get into tax brackets. We're going to go back to those tax deductions. I'm not forgetting about that, ladies and gentlemen. I'm not forgetting about it, but we're going to get to these tax brackets. Now, 2019 tax brackets. Okay, we're still talking about 2019 because that's what we're filing. We're filing 2019. Now I'm gonna give you the single rates, and I'm gonna give you the married filing jointly, and also head of household. Because you're gonna need. Matter of fact, what about we just go over them together? How about that? How about it? Let's just pop over there. Let's see what we can do here. All right, here we go. If you look at the chart here, ladies and gentlemen, you have 2019 at 10%. So if you make anywhere from $0 to $9,700, your tax rate could be 10%. Okay, and this is easy math. You can just do this. So do whatever you make. So if I made $19,400, I'll do times 0.10, and that's how much you're paying taxes. So let's do that. Let's pop a good old calculator up. Calculator. Old calculator. Doing it right here in front of you so you can understand the math. Here we go. We won't do that low number because there ain't no money. But as you look through, you make less than $10,000, you're paying 10% tax. So let's do something that makes more sense. Let's go 22% bracket tax rate. So you make $39,000 up until $84,000. If you're a singer, if you are single, you'll be paying 22% in taxes, right? Married, filing jointly, you'll be paying $78,000. I mean, if you're making $78,000 to $168,000, you're still in this bracket. If you're married, filing jointly, $39,000, $84,000 is the same as the ones filing single. And then head of household, $52,000 to $84,200. Okay, so we understand where we're getting at. So let me explain the tax deduction for you. What's going on, Ashley Hawkins? Nice to see you. Oh yeah, we're talking about little taxes. I ain't no tax professional. I'm just a tax aficionado. Okay, I know a little bit about taxes. Help you with your tax return. Help you with your money. But you better not have me to file it. I'll fuck it all up. Excuse my language. Anyway, because I have a tax person who do mine as well. Anyway, let's look at this. So let's take, for instance, the 20. We're right here, guys. We're right here on this block right here. Okay, we're on 22% tax bracket. So let's say, for instance, you went in and you did that $5,000 like I do every year with Goodwill, and you have it for your last year, 2019. This is 2019 tax return, and you made $39,000. Okay, you made $39,000. And you are single. Subtract $5,000 for $39,000, you got $34,000. Guess where you jump at, ladies and gentlemen? You jump into the 12% tax bracket. That's almost half. Okay? That's almost half. That's what, 8% less. So let's do the math here. First, let's take 84,000. 1, 2, 3 times 0.22 equal. They saying in a course of a year, you'll be paying $18,000, $480. Okay, $18,000 in taxes. If we do it straight out with no deductions, no itemizing, we're not claiming this, we're not claiming that. This is straight out according to the tax bracket. This is how much you'll be paying in taxes. And he's like, man, I pay a lot in taxes. Yes, you do. Yes, you do. The reason why I'm putting emphasis on you. You better do some exemptions. Now let's go back. So if we do that now I said 84,000. Let me be real. Let me do 39,476 because that's what we're on, right? So 39,476 times 0.22 equal. You're paying $8,600. So I'm gonna write this down so I don't forget. 86,8472. Now I'm gonna give you the trick of Goodwill. So a lot of you understand what I do. My problem is I can be too real sometimes. That's my damn issue. So we do that because up until, see, here's the thing. The reason why I say $5,000 is the key to do a deduction when you donate to Goodwill and you get that receipt, they call it. Most Goodwill people or say, do you want a receipt? You say yes. The only thing they're going to do is sign and date it. They're going to have you to fill it out. And when you fill it out, you fill out the item and you fill out the amount. Now, this is where the Honest Society comes into play. They're going to give you that receipt and trust that you're going to itemize your things on that receipt and show, right? There's a little yellow bar down here, excuse me. Get out of there. And show how, what you donated. Me, every year I'm always doing $5,000. Now, $5,000 worth of stuff. Now, granted, you can use it for anything. Anything. Now, if you're filling out yourself, the only thing the IRS needs to see is this tax ID form, ladies and gentlemen. What's going on, Wayne Peterson? Thank you. Thank you for joining in today. That's the only thing they need to see. They're not going to say, well, let's go back and check the Goodwill you went to in Bum Diddley, Alabama. We're going to go to that Goodwill and check to see every item. No. Once you get that form from Goodwill and they sign off on it, the IRS uses that. But now, the reason why $5,000 is important, because if you go over $5,000 and donate in charity, it generates another tax form. So if you don't want to get into the point where they come and audit you, oh, Lord have mercy, and come and audit you, do not go with $5,000 on that form. Just make sure you keep it at $5,000 or less. I'm always teetering at $4,997.98, okay? I like to be on the edge, but I don't want to jump off because that will generate another tax form, okay? So we was at $39,000, right? And we're going to pay, we did the tax bracket right here, ladies and gentlemen, at 22% because we make $39,476 and we're single, and you can apply this to any bracket. I'm just doing the first one, okay? So we donated our $5,000 worth of Goodwill stuff and we got our receipt back. So now we at $34,000, okay? We're at $34,476. And then that puts us in the lower tax bracket. Now, granted, as I said, these Goodwill people just give you the receipt and have you to fill it in. Ding, 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 ding. I'm not telling you to do nothing illegal or fraudulent, but you get my point, hopefully. Okay. So now I'm gonna put in 34,476 times 0.12 at 12% equals, holy chamoly, 44,137 and 12 cents. Okay, now my previous amount, so let's do the math here. 8,684 and 72 cents minus, because we got to do the differences for you to understand the savings in this. 41,137.12. I'm sorry, I added a couple of numbers. My bad. Let me do it on my keyboard. 8684.72 minus 41,337.12. All right, that looks better. Savings of $4,500 you'll be saving in a year. This is ridiculous. You see what I'm talking about? That's why your boy gives to charity. Now, sometimes I feel like I only give a couple of items, like a shirt or t-shirt that I don't wear anymore, and I still turn in my things and get my $5,000 worth of deduction that sometimes put me in a lower tax bracket. Hopefully you understand what I'm talking about, ladies and gentlemen. This is very legal. This is very legal to give you the tax form. So let's do this. Now let's divide this number by what? 12. Because this is going to then tell you how much you'll be having back in your pockets, okay? How much you'll be getting back on your tax return, okay? Or how much you'll be saving. So I'm going to divide this by 12. Boom. Oh my gosh. $379. I'm rounding up. $379. What could you do with an extra $379 a month? Oh, and then look at your tax return. Look at your tax return, okay? Look at your tax return. Your tax return is going to be awesome. Okay? Because, like for me, filing single, and then I use certain deductions that'll lower me in a tax bracket. Now, I'll be having more than one deduction, but this is the one that anybody can use because it's easy. $379 a month, $4,500 a year. Are we serious right now? I'm going to move right along, ladies and gentlemen. I'm going to move right along. I'm sorry. I don't want to get caught up in that. Let's go back into our interest rates, our deductions. HELOC, a lot of you heard of that's your home equity loan, HELOC. Previously, you could deduct interest on a HELOC loan, your home equity loan, and home equity line of credit, just as you could with a mortgage. No matter how you use the money, the deduction is going away, at least in part. Okay, beginning in 2018, you cannot deduct interest on these types of loans, except under certain circumstances, even if you took out the loan the year before. All right. The one that people love and hate. You don't love it, you just hate it, okay? Mortgage interest deduction. Though it's not specifically related to this TCJA, the Schedule A deduction for mortgage insurance premiums, expired at the end of 2017, it's possible Congress will reinstate this deduction for 2018 as it has in the past. To find out, you got to go to the IRS. That's what I put down. Casualty theft deduction, we won't get into that. Let's see here. Let's see. Here's some good ones. Here's your miscellaneous item deductions. It said miscellaneous Schedule A item deductions subject to a 2% of your AGI. AGI, again, is adjusted gross income. So your AGI threshold have gone away beginning in 2018. A lot of things have been going away. Thank you, President. This includes deductions in the following categories. Okay, these are going away, ladies and gentlemen. Unreimbursed job expenses. Okay, let me get into what I put on here. All of these are gone, boy. I tell you, I write weird. These are the work-related expenses you paid out of your pocket and include travel, transportation, meals, union and professional dues, business liability insurance, depreciation on office equipment, work-related education, home office expense, cost of looking for a new job, legal fees, work clothes and uniforms. All of these deductions are gone. I used to see these and I didn't know, what is all this? And my CPA rep, he like, yeah, man, you know, with these you can actually do deductions for, but they're gone. So a lot more people are paying a lot more in taxes. You're going to see that we can spend more money in America with the military, with federal loan grants, federal anything, because we're simply paying more in taxes because they have taken away the tax deductions. So itemized deductions, these are the miscellaneous ones that you probably, some of you were actually filing. Now this is why it hurts. Your best resource is to ask your employer to reimburse you for these expenses because they're no longer tax deductions. See, when I worked in certain entities of the job, if I bought a meal and my job didn't pay for it, I could use it as a tax deduction. You get what I'm saying? Like, what if your job say, hey, we need you to drive from here to the Capitol building, right? And you had to use your own car. And that was part of the job that you signed up for. They say, hey, infrequently, we're going to have you to drive to certain places no longer than 30 minutes. That's part of the job, and we're not going to pay you for that. So you either take it or leave it. And you're like, okay, that's not a problem. But you used to file that on your taxes as a deduction. No longer. That's what I'm talking about. I'm going to read it again so you understand you can no longer file these on your taxes. Travel, transportation, meals. Now, granted, if your job is paying for it, then cool, you're good. But if you was claiming this, right, for your job because they wasn't covering it, you can no longer do it. Travel, transportation, meals, union and professional dues, business liability insurance, depreciation on office equipment, work-related education, home office expenses, cost of looking for a new job, legal fees, work clothes, and uniforms. All of them are gone. What about investment expenses? These are fees for investment advice or management. Tax or legal advice, okay? Rental fees for safe deposit. Although these items above are no longer deductible, You borrow money to buy investment. Interest on that loan called investment interest is deductible for your itemization. So if you borrow money to invest, you can still have that as a deduction, but I don't know why you would do that anyway. All right, tax preparation fees. Tax preparation fees. These include the cost of tax preparation software, hiring a tax professional, or buying tax publications. Also gone are deductions for electronic filing fees and fees you pay to fight the IRS, including attorney fees, accounting fees, or fees you pay to contest a ruling or claim a refund. If you hire someone to prepare both your personal and business taxes, ask for a separate bill for each. Fees you pay to prepare your business return are fully deductible as a business expense. Do not combine the two because you no longer get a deduction on your personal one, only on your business one. Hobby expense. These expenses, up to the amount of income you earn each year, are no longer deductible, even though you do not have to report and pay taxes on them. Any income from your hobby, if you sell goods related to the hobby or to the customer, you can deduct the cost of those goods when calculating hobby-related income. Okay? Let's talk about a couple of these. Itemized deductions that are left. A few miscellaneous item deductions remain. These are the ones that you can still claim. Gambling losses are still deductible under the TCJA. That's the Tax Cuts and Jobs Act. Up to the amount of your winnings for the year. Gambling losses are not subject to the 2% limit on miscellaneous itemized deductions. So you can still claim gambling losses. You can claim graduate student tuition. Waivers remain tax-free. Interest on student loans continue to be tax deductible, even if you don't itemize deductible. Okay, even if you don't itemize your deductions. Classroom teacher deduction. The $250 deduction for classroom teacher is still in effect and available, even if the teacher does not itemize. The standard mileage rate, okay, the standard mileage rate deduction for 2019 for medical reasons is 20 cents per mile, and the rate for charter remains the same as 14 cents per mile. And last but not least, improving deductions, improving. And I'm going to read your comments and answer any of your questions that I can answer. Improving deductions. Along with the new standard deduction, several other are better under the new Tax Cuts and Jobs Act. The estate. Now, I want you know what? I want y'all to really analyze some of the name of these taxes and see who they really help out. The estate tax exemption has increased from 5.49 million in 2017 to 11.4 million in 2019. The estate tax exemption has increased. Exemption. Student loan debt discharge due to death or disability will not be taxed beginning in 2018. Previously, the charged debt due to disability or death was taxable to you or to your estate. Itemized AGI deductions, adjusted gross income deduction. There is no limit on itemized deductions based on AGI starting this year, although other limitations may be imposed depending on the deduction. And then last one, my favorite one. Yes, this is the time where I get a good cup of tea. Well, in this case, some organic lemonade. That's good. Then I tell myself, charitable contributions now include a higher limit threshold. Most gifts by cash or check can be up to 60% of your AGI, your adjusted gross income, versus the previous limit of 50%. So that went up 10%. In addition, the TCJA repeals the P's limitation for both charitable donations and the home mortgage interest deduction, which reduce itemized deductions for income individuals. So, as I look through these things, guys, give me a second, and I'm gonna look up the charity deduction maximum, right? Because that was speaking some sort of limit. All right. So right here, they're saying generally you may deduct up to 50% of your AGI, but 20% and 30% limitation apply in some cases. And this is coming right from the horse's mouth. This is right on the IRS website. If you guys want to look along, you can. Here we go. Charitable contribution deductions. And we can look at this together. Let's look right here. If you donate property other than cash to a qualified organization, you may generally deduct the fair market value of the property. If the property has appreciated in value, however, some adjustments may have to be made. That is not what we're looking for, ladies and gentlemen. It's qualified. Let's see, charitable. I think this right here is what we're looking at. Okay. So what we need is a dollar amount. Okay. And I'm going to find that out for you guys. I'm going to find out. I'm going to leave that in the description. That's quite a bit of information. Okay. I apologize for that. That's quite a bit of information. So I'm about to look at your notes here. All right. Let's see. It says, Ashley Hawkins, charity is a big tax off. Indeed it is. Wayne Peterson, if you are self-employed, can you write off meals? So yeah, you can write off meals. But let me tell you, when you are self-employed and if you're not a tax professional yourself, I advise you to get a tax professional because they're going to have the charts, they're going to have the guidelines, the regulations, the government, information in order for you to do it correctly, rather than you try to do it yourself of the amount. Because a lot of times they may have an amount. Like if you're feeding yourself because you're self-employed, you're not going to just deduct and exempt $100 meals every meal, $300 a day. I'm pretty sure there's some sort of limit. Wayne Peterson also says, all the things you mentioned, does that apply to self-employed people? In some aspect, it does, okay? Again, my disclaimer is I'm a tax aficionado. I know a little bit about taxes that I like to teach people about, those extra few things. But at the end of the day, it's best you give it a tax professional and you can raise the question of the things that we actually covered today. All right, I got about 14, 15 more minutes on here. So I'm going to move on to another topic. Okay, guys, I'm going to move on to another topic. And this topic, we're going to talk about, some of the things that you probably need to know before you refinance your house. First of all, you need to know how much equity is in your home, because a lot of times when you refinance your home, it pulls a lot of equity out of your home because you're starting a new loan. Because this is why when you refinance, they say, hey, because you're refinancing, this is a new loan, I can give you an equity check. And that's your sort of like equity line of credit, but it's not credit, it's your money that was built up because the appreciation of the house. Sometimes this money could be $2,000, $4,000, $6,000, $20,000. And so what people do with this particular amount of equity that is coming from them because they're doing a refinance, they remodel the bathrooms and kitchen to improve the value of their home even more. All right. Or maybe you want a deck. People love deck. I love a deck. Everybody loves a deck. But when you get a deck, make sure you get a roof or an awning so you can be protected from the elements. Because at any given point, you can always put a little mosquito net. And then now you have a whole nother structure. You can go chill outside, do what you do. Okay. Know your credit score. Know your credit score. It's very imperative to know your credit score and work on your credit score if it's not over 720. Because you're going to get an astronomical rate on your loan when you're trying to refinance. I see Camilla Walker says, what about reinvesting your profits in the stock market? When you say reinvest your profits, I have all of my, let's say for instance, all of my dividends, and I'm off topic. I'm going to get back to the refinance mortgage, guys. I have all my dividends. I have all my appreciation reinvested already automatically. But what happens is when those appreciation hit as an overage and it just sits in your account and is not being invested, after 30 days, that money will be reported and it can be taxed. So what you're asking me and what I believe is, should you reinvest your profits before 30 days? And the answer is yes, you should. Moving along. So we talked about credit score. Build your credit score, okay? There's a lot of entities to build your credit. How long you had the credit, your credit history. Do you have any delinquencies, any late payments, any foreclosures, any debts, any collections, etc. But you want to over a 720 credit score because that's when you can start to compete for those top tier low interest rates, especially when you're refinances. You need to know your debt to income ratios. Regardless if you have a house, regardless of how much money you have, they're looking at your financial portfolio. They're looking at your credit. They're looking at, oh, wow, yeah, you're a millionaire, but look at your debt to income ratio. You have more debt than income coming in. We can't give you this loan. Okay, that's very important, ladies and gentlemen, because your debt to income ratio also ties into your what? Your credit score. Correct. You got it. Your credit score. Then I'm going to read this particular, I copied this out of Investopedia. It says the cost of refinancing. Refinancing a home usually costs between 3% and 5% of the total loan amount. Again, refinancing a home usually costs between 3% and 5% of the total loan amount. But people who borrow can find several ways to reduce the cost of can find several ways to reduce the cost or wrap them into a loan. If you have enough equity, you can roll the cost into your new loan, increasing the principal. Some lenders offer a no-cost refinance, which usually means that you will pay a slightly higher interest rate to cover the closing costs. Don't forget to negotiate and shop around, since some financial fees can be paid by the lender or reduced, or they don't even have any. Okay, I see another question. Do I get a tax break if I don't withdraw for a year? Now, when you mean, do you get a tax break on which one? See, in my opinion, here's the thing. If you are investing and you received a, let me look at, I got an email today. I got it from Goldman & Sachs, and I had a couple of dollars in there, right? And they want me to download this document. Where is it at? Here's my tax document. It's a 1099 INT. Okay, it's a 1099 INT. Why they won't let me open it? I'm trying to open it for you now so you can, I'm gonna show you mine essentially. If it opens up, I gotta open up with some sort of paint thing here. As that's opening up, I'm gonna move along to rate versus term. While many people who borrow focus on the interest rate, it is important to establish your goals when refinancing to determine which mortgage product meets your needs. If your goal is to reduce your monthly payments as much as possible, you will want a loan with the lowest interest rate for the longest term. If you want to pay less interest over the length of the loan, look for the lowest interest rate at the shortest term. So this is kind of what I've been telling people for a very long time on my channel. If you can afford, and you can, it just matters on the amount of the house, right? Not the square footage and how many rooms it has, no. How much is the house? Because I tell people, do a 15-year mortgage. Now, I'm just gonna throw out some arbitrary numbers. A 15-year mortgage compared to a 30-year mortgage, it differs in price a month. So let's say that a 30-year mortgage would be $1,800 a month, where a 30-year mortgage would be $1,800 a month, but a 15-year mortgage, because you're paying your loan off in a shorter term, okay, rate versus term, because you're paying your term off shorter, a 15-year term, that bill could be anywhere from $2,500 to $2,600. Sometimes it's $500 up to $1,000 usual of a 30-year loan. But here's the thing, ladies and gentlemen, if you can do it, you should do it, because I'll put a spin to it. If you are 35 years old, and you do a 15-year mortgage, and you pay that off in 15 years, how old would you be? You'll be 50, right? You'll be 50 at 35. You'll be 50 and you'll own your own house. Your house will be paid off at 50. There's people I know still paying on their house. Okay, and they're beyond the age of 50. Let me flip it. You do a 30-year mortgage at 35. How old are you at 30 years? Yeah, you're 65 now. You're 65. So you pay off your loan 15 years earlier. What could you do at the age of 50 that you probably don't want to do at the age of 65? You probably don't want to travel as much at 65. But when you're 50, you probably still want to travel. You're still young. You still want to have fun. There's something to think about. Okay, let me go back over to, was it Camilla Walker's question? Let me see if this popped up. It never popped up. I'm trying to pop this up for you, but it's not doing it for me. Click the download icon. Oh, there it is. Okay, now it wants to download. Anyway, let me read some of your notes here. So if I don't withdraw my profits and reinvest instead, it's not a tax break. You just won't be taxed because it'll still be in your investments. But you won't be taxed. Now, granted, this is weird because this is why I want to show mine, and it won't let me show mine because the way they tax it is different. I'm gonna log in real quick if I can remember. This is an old savings account I had. I think I had like $3 in here, ladies and gentlemen. So don't look at my amount of money. Okay, look at the money. Look at the money I didn't have. All right, hold on. Got to do a verification real quick. I'm doing this for you guys, okay? Don't think I feel like doing this. Boy, I tell you, sometimes the truth just spill out my mouth. Okay, let's look at this tax form. Oh, welcome back. Statements. I'm glad you guys for staying with me. I appreciate it. I appreciate it. All right, so I'm gonna flip it over here, guys. All right. Now and again, not much money in this account because I have too many accounts. Let me throw this over here. That is way too big. Okay. Okay. Whoa. Let's not look at some of this personal information. All right. Say, look. So interest. Let's look at the interest on this account. $10. Not too much, right? But I have to file this stuff. Okay. I have to file this stuff. So even though I only received $10, look, IRS description 00000 interest income. That is the main thing I'm paying taxes on, is the interest that I made on that account. Okay, is the interest that I made on that account. That is all. Okay, that is all. That is all. It's the interest that I paid on that account, which I told you wasn't much because I think I had like, I don't know, $10,000 in there, and it was at like point whatever cents because their amount went down. So I didn't have much money in there, so that's why I'm only paying 10. And that's for a savings account of interest. Now, your investments accounts may get a form that says 1099-DIV or 1099-INT because depending on how they structured it, it could be dividends or it can be interest. So there are two different forms. One is INT interest, the other one is DIV dividends. But nonetheless, you're paying taxes on the money that you made, regardless if you left it in the account that was not invested or not. But you're not being taxed on the money that you contribute to invest or you saved. Okay? All right. Hopefully I answered your question on that one. Let's look into the all right. Refinancing points. When you compare various mortgages loan offers, make sure you look at both the interest rates and the points. Points equal to 1% of the loan amount and are often paid to bring down the interest rate. Be sure to calculate how much you would pay in points with each loan, since these will be paid at the closing or wrapped into principal of your new loan. All right. Know your break-even points, like your negotiating term. Know where you're going to say, okay, I'm not going to pay that interest rate, and you walk out the door. Know how much for per square footage of your home, how much you're going to actually pay, and also in comparison with your interest rate. Okay. Now, granted, we understand that your interest rate has a large portion to do with your credit score. That's why I always tell you guys, look in the description of this video. I have my business email for you guys to request the free credit letters. It don't cost you a dime. It don't cost you a penny. It costs you a little bit of time, because when you request these items, say, hey, Ross World, I'm requesting the forms to delete collections off my credit report, or any other, and name some other financial issues you may have, maybe be debt or school collection, medical, pay deletion the letters, whatever it may be. I'll send you what I have, but it doesn't require you, which I've had a lawyer to look over it, because you have to notarize it when you send it out to the IRS. But it's going to have a form of ID on it, and it's going to start to work and delete collections off your account that you did not sign, or that's been over a certain amount of years, like 7 years, or even sometimes 2 years, depending on if that company kept your record. That's why I say, you want to buy a house, you want to buy a car, you want to buy it at low interest, very low interest, then make sure your credit score is over the score of 720. Now, we understand that a perfect credit score is, I believe, was it 850. The reason why I say 720 has been deemed that special score that gets you the 800 credit score interest rates. So either you have 800 or 720, in between those numbers get you the lowest interest rate statistically known for about the past 10 to 15 years. That is why I'm getting on that. Now, private mortgage insurance, PMI. Homeowners, this is key. This is key. I tell people, save your money. Save your money. Put a good down payment down on your house, or you'll be paying PMI. And listen to this. Homeowners who have less than 20% equity, in their home when they refinance will be required to pay PMI insurance. Private mortgage insurance. If you are already paying PMI under your current loan, this would not make a big difference to you, but some homeowners whose homes have decreased in value since the purchase date may discover that if they refinance, they will need to start paying PMI for the first time or for the second time. The reduced payments due to a refinancing may not be low enough to offset the additional costs. Okay, let's branch out a little bit. Let's talk about PMI. I'm gonna give you the definition of PMI, and then we're gonna go back. What is private mortgage insurance? If the concept of buying insurance on your mortgage sounds a little odd, you're probably a newcomer to buying property or never put down a small. And then I'm gonna break it down to the way I do. I like to give you that way, and then I give you my way. Most lenders require PMI when a home buyer makes a down payment of less than 20% of the home purchase price. Most lenders require, when you pay less than 20% of the purchase price, for you to pay PMI insurance. PMI insurance. It said, so basically, let me just break this down really quickly. So they say, you know what? If you do a big enough down payment, you don't have to pay PMI, private mortgage insurance. But because you don't have enough capital, enough money, that much revenue to put down at least 20% of the house price, that means that, okay, we're not going to come away with nothing because you don't have the amount that's set forth by the U.S. government, essentially nationwide. So you're gonna have to pay us insurance, and it's quite crazy because you're paying house insurance and you're paying mortgage insurance, and the mortgage insurance you're paying that to the people who actually lend you the money. Because it's kind of like when you buy a car, right? They require you to have what in your car if it's not paid off? Car insurance. Did you know that? Did you know that? When you have a car and you're paying a lender money, you have to have full insurance. Because that is their car. Yeah, you wrote your name on some stuff, you signed some paperwork, but it's not your car. Stop paying on it and see what happens. That is why you have to pay full car insurance. That's why they ask you the car fully insured. And that is reported to your lender. You ever took off coverage of your car because you couldn't pay your insurance? And then your lender contact you and say, hey, we heard you took insurance off the car. Did you know you can't do that? You have to insure the car until you pay off the car, sir. It's not your car, sir. Ma'am, it's not your car. That's why you're still paying a monthly car note. Yes, we know you tinted the windows. Yes, we know you put a new radio in it. Yes, we know you had it detailed. We understand you got 20-inch rims on it, but it's not your car. Because at the end of the day, whatever you did, we can come take that car because you didn't put proper insurance on it. It's the same with this. If you don't pay your PMI insurance, they will take your house because that is the stipulation. If you do not put 20% or more down on your home, you have to pay private mortgage insurance. And if you don't, they will take your home because they want insurance. They figured out a way to do what the cars are doing. So let me look at your tax and I have to get out of here, okay? All right. Wayne Peterson said, good point. Wayne Peterson says, I've been researching dividend stocks, but it seems like a bit tedious job to track dividend stocks individually. Which company should I go with to buy an ETF account that pays dividends? What company? I have a 25 to 30-year dividend reinvestment plan for retirement. Here's the thing, Wayne. I invest my money in different entities, right? And take for instance, Stash. I have a Stash link in the bottom. With that said, with Stash, they have over 20 to 30 ETF/index funds. And they grab these funds from different entities like Vanguard, Merrill Lynch, Charles Schwab, Fidelity, Edward Jones, the Russell Group, etc. And most ETFs and index funds give what? Dividends. Now the issue with Stash right now, and they're planning. Wait a minute, is it Stash? Did they start doing it yet, or is it Robinhood? I believe Robinhood is about to do it. They haven't done it yet. When you start receiving dividends, Robinhood just leaves it in your account. So you have to reinvest it manually. Okay, it's not automatically like some of these other investment platforms. Take, for instance, my Wealthfront, okay? I'm gonna pop up my Wealthfront. And they reinvest my dividends and my appreciation that I receive from my accounts automatically. Problem with me is, guys, I'm very transparent. That's a bad thing in finance because people start to judge you, but like I give a damn. They're telling me right here today I'm worth $98,000. Broke as hell. But at retirement I'm worth 1.1 million. Okay. So you know what? Let me see here. Let's look at this. Let's look at this. Okay, let's look at this. I'm gonna let you see. How much I'm gonna let you see? I'm gonna let you see a little bit of my account, okay? Just a little bit. Yo. All right. Here we go. As you guys can tell right here, it says that investments, $118,000 investment, and in my Wealthfront account, I have $11,000, okay? Then it says at retirement age, I'll have $1.1 million I can purchase a home in a year. I have here's to the top right. Look at my average savings rate, 6%. That's pretty low. Pending transaction. So I'm all over the place. Let's start talking about my savings rate, 6%. Pending transaction, $250 a month. Okay, this is one of my investment account. Okay, guys, this is not my Robinhood. This is not my M1 Finance. This is not my stash. This is one of my investment accounts. I love Wealthfront. I just like how it's plain and simple. Okay, so I'll be worth a little bit more than 1.1 million at the age 65 if I calculate all my other accounts, like my Vanguard account, my Fidelity account, my what's that other one? Charles Schwab account. Okay, but right now it says investment 118. That's with Wealthfront. Okay, and it says right now, because I have some other accounts listed right now in this particular account, because you can have multiple Wealthfront accounts. This is the personal one that I just want to gain some money off of. The other ones are my other ones are IRA and Roth. Yeah, Roth IRA. Okay. All right. So that's my account with that. So you guys can see a little bit of that. We're back at it. All right. Here we go. So when I look at these investment guys, when you say you have 25 to 30 years of investing, now I've done some things that are not totally smart, and anyone in the financial world will tell you it's not totally smart, because the more money you have in an account, see, in my infinite wisdom and me trying to figure out things about money, is I say, you know what? I want money everywhere. I want money everywhere. I want this account, that account, this account, that account, this account, that account. Thought I was doing big things, but let me tell you, ladies and gentlemen, that's dumb as hell. And any financial advisor would tell you. That's why I like giving people financial information, because your boy made a lot of dumbass mistakes. Yes, he did. Yes, he did. I made a lot of mistakes. And I used to have all these accounts. Now I only have like 3 or 4, but I used to have like 12, 15 accounts. Then somebody said, you gotta have a high interest rate here and you are investing there, but your money is not really making you money. And wear a shirt, say my money makes money, if your money is not making you money. Don't make no sense. You get what I'm saying? Because the more money you have in an account, you can invest, it will invest more, and it compounds on itself. It's like a savings account, ladies and gentlemen. Think about it like this. If I have a savings account that had $10,000 in it, I'm getting, and the savings rate was at 2%. It's giving me 2% on my $10,000. But I say, you know what? I got 10,000, I'll put 1,000 in 10 accounts. So now it's only giving me 2% on 1,000. That's pennies. Now, granted, my account I'm currently with Sterling Bank. It's called Brio Bank, BRIO Direct. But the parent bank is Sterling Bank. And they're giving me, was it 1.8, 1.9? I forgot the amount. But they just gave me a deposit of $15. The last month deposit was $13. This is great money. I'm getting free money to save my money. And this is for my investment account, okay? I'm sorry, my savings account, my rainy day account, my emergency fund account. They gave me $15. Think about this. If somebody walked up to you randomly and say, oh man, here's $15. You're like, man, what's this for? Now, some of you may say, well, $15 ain't no money. $15 is some money. Now, granted, we all know they take our money, these banks, they take our money and they invest it. So they're making more money than they're actually giving us, but we need to have our money in some safe place, and they know that, and we love the fact that it's backed by the federal government, because 99.9% of the times you can get your money back, okay? Can't say 100%. Nothing is 100%. And so with that, we have to understand that when the bank gives you a high interest rate, according to other national banks, like anything over 1% nowadays is a high interest rate, because your U.S. banks, your Bank of America, your was it Wells Fargo, all these other banks are giving you less than 1%, less than 0.25%. Most of them are 0.15%, 0.10%. And you don't even have to know math to understand that that's no money. So this bank I'm with right now, Sterling Bank, they're giving me like 2%. So they're giving me $15 a month. And I ain't the smartest man in the world, but $15 a month for you to hold my money? Exactly. So let's do some math here. Let's do some math. I love doing math for you guys because it's gonna help you to understand how much money you could be potentially receiving. Okay, that you can potentially receiving. So if I'm getting $15 a month, let me put this back on here. If I'm getting $15 a month over 12 months, how much is that? About $180, give or take $1. I don't know, $180, right? So $15 a month for 12 months, $180. Could you do something with $180? I think I could. I could take a trip, not a long trip, maybe like a day trip, gas, food, go down the street. I don't know. Buy groceries. $180 probably. Yep, that'll be like a month and a half of gas money. If I keep my daily routine, what I say, groceries, buy some video games, pay a couple of bills. I can invest it. I said that before. Save it. Pay off maybe a field trip for my, for your kids. You can do a lot with $180. So that's the point I'm getting at, is interest is good on your account. That's all I'm getting at. All right, guys, I'm about to get out of here. I'm going to read Wayne Peterson's last note here, and then I have to go. Wayne Peterson says, thanks for that. So Wealthfront is a one-stop shop. For me, I like Wealthfront. If you look in the description of this video, Wayne, there is a link, and use that link. And with that link, they will manage your money, because let me tell you this. After $5,000, they will charge you a small interest fee because they are managing your account. And it's great, right? And the reason why it's so low, is because they are a robo-advisor, but they have humans in the back making sure that everything is working perfectly. I've been using Wealthfront for the past 3 years, and it's made me good money. It's made me good money. So you have different entities in there. You have your Roth IRA, that's your retirement account. You have your regular personal investment account. That's the money you can take in and out all day. You want to make money, spend money, whatever money, okay? But I have a link in the description for you to use, and they're going to increase managing your money up to $5,000 or even more. But again, the fees are small, so I can care less about the fees. Long as my key is 1%. The fees are lower than 1%, lower than 0.5%. Because even when you get over 5,000, I think it's, no, I'm sorry, I think it's 15. Hold up, let me look it up. Gosh darn. Wealthfront management. Okay, yeah. So the first $5,000 a fee if you use my code in the link description below. And then after that, they're going to charge you 0.25% for management. That's it. Not even 0.5%. So it's cheap. So that's why I tell you, don't you worry about the fees if it's less than a percent or less than 0.5%. Very, very low. And they do a great job, in my opinion. They do a great job. Okay. All right, Mitch Madden. I want to claim 9 all year. Laughing my. All right. Anyway, this is Financial Literacy 101. I'm your host, Ross World. I want you to learn money and be inspired, because at the end of the day, ladies and gentlemen, my money makes money, and I'm out.